Is it trick or treat for the markets? Because the market has just entered into correction mode. Where are we headed to next? Let's discuss. My name is Dan Slim, and welcome to another episode of Monday Market Out. So we've been talking about the possibility of an off-cycle rate hike as announced by BSP Governor Eli Remolona Jr. And yes, it happened. So the BSP announced a 25 basis point rate hike that took effect last Friday. Now, this caused Philippine bond yields to spike up midweek, the 2-year bonds hitting resistance at 6.58 before coming down at 6.35. But the 10-year and 20-year yields saw massive moves last Friday, closing at 7.09. Oh, what happens to the markets when yields go up unexpectedly? The markets go down. The PSEI broke the 6,000 support level to settle at 5,961, taking us towards our next support at 5,850. But we do have a soft support here at around 5,900. No? We were thinking that this rejection candle here could still put us above 6,000, but a strong market pressure continues to haunt investors. Now, if we look at the 15-minute charts, we always say that in a strong downward market, rallies tend to be met with sell demand, and this is exactly what happened to the PSEI. So we see every time the market wanted to rally, it bought the dip, rally here, but it was instantly met with sell demand 3 times. A rally here, then boom, a rally, and then boom, a rally, and then another sell off here. So what spooked the markets is the off-cycle rate hike plus the possibility of another rate hike as announced by the BSP governor, which was totally unexpected, mainly because the peso has been stable along this range. So what's up? Why did the BSP increase interest rates just like that? Maybe they are anticipating higher than expected inflation for October, because in a recent report, the budget deficit of the government has widened to 250 billion pesos due to increased government spending. And to make matters worse, this was coupled by the 11.57 decrease in government receipts. We are seeing a massive increase in government spending, maybe due to the pressures for the Philippine economy to grow by 6% this year. Let's look at some earnings here. Pure Gold reported 2.1 growth in their net revenues and a 9.2 top-line growth. That's not really exciting, especially when you see net margins going down because of higher costs. And really, the top-line growth was actually just influenced by inflation. Now, next up, we have BDO. Rates hike should be good for banks, as we've seen how net interest margins have helped boost back earnings so far. BDO also coming out with good earnings, but the thing with net interest margins is that, like BPI, the margin growth has already significantly slowed down for BDO. So again, we are seeing some signs of topping in the banking sector. But with the recent rate hike though, could banks still have more upside? No, I think we've come to a point that the economy may not be able to digest another rate hike. We are probably past a sweet spot on interest rates where it has become too expensive for businesses to borrow money. This increase in interest rates can significantly slow down the property sector also, as we may start seeing less demand for housing loans due to the higher cost of borrowing. Now, going on to the global markets, we see services PMI back to expansion territory at 50.9. Core PCE and PCE numbers coming in line with expectations, but look at that GDP number, 4.9%, way high, hotter than expected. And what did we say last week? If it is above 4.3, all hell break loose. And that's what exactly happened to the markets. Let's look at the S&P 500. The S&P 500 just entered into correction territory, having dropped more than 10%, from the high here at 4,600 down here. We are down 11.5% and at one point around 11.9%. So far, the support here at 4,100 was able to hold, and the markets bounced back nicely off of that level. Could this rally be met with sell demand also next week? So a lot will again depend on earnings next week. Remember that we said that only 7 stocks were keeping the US markets up, and that earning seasons will see if these 7 stocks will continue to do so. It was a cloudy week for Alphabet last week as the Google stock got sold down mainly due to the cloud computing business expectations miss. Most of the revenues were up. Meanwhile, Microsoft's cloud business doing quite well, coming in above expectations, which saw Microsoft shares go up 3% only to go back down in the same level. Now, Amazon also beating expectations as net revenues grew 300% year on year due to aggressive cost-cutting measures. Now, remember that these 3 companies are the leaders in the cloud computing field. Amazon is number 1 with around 90 billion in cloud revenues. We have Microsoft on second place at 70 billion cloud revenues, and then Google Cloud Platform at third place with 33 billion in revenues. So we can see how important it is for Google to maintain its rapid growth, because among the 3, Google still has a lot of margin to grow, and if they're not growing that fast, it spells trouble for Google, which is why the market behaved that way. Now, speaking of cost-cutting, Meta also reported better than expected earnings with revenue gaining 23% on year-on-year quarterly numbers, and also mainly due to what's termed their year of efficiency as Meta went into aggressive cost-cutting measures last year. Now, so far, the Magnificent 7 stocks were overall down this week with mixed results last Friday. Now, going into next week, we have these companies reporting with their implied movements depending on how well they will do or how good their forward guidance will be. So we have here some possible big moves from Moderna, PayPal, Dash, Airbnb, Shop with implied movements of up to 12%, either to the upside or to the downside. Now, Apple here with a possible plus or minus 5% after they report. Let's see, because the latest numbers show Huawei gaining more phone sales in China compared to Apple. So are we seeing the Apple stock go down this week and bring the S&P 500 along with it? Meanwhile, the 10-year bonds taking a swipe at the 5% level before going down to 4.83, with the 20-year bonds also going crazy. Now, what is that? No, but eventually closing at 5.2%. The whole steep climb of government yields may actually not be a very good sign. No? So if we look at historical charts, we can see how previous times when yields went up as fast as it went up now. During 1977 here, bond yields went up so fast. And again here around 1987, bond yields went fast, which forced the Fed to drop their rates even below 0% to stimulate the economy. Here's another interesting chart which may also point to worse things to come for the US economy. Bankruptcy filings are currently at one of its highest levels, at the same level as the 2008 recession and the 2020 COVID pandemic crisis. So are we going to have a difficult year for the US economy in 2024? Now, looking at this inversion of the yield curve, we are hovering along this support line here. Could we see yields go down below 1% soon? Because what happens when yields become disinverted? So if we look at this chart, so looking at past years when we have an inversion in the yield curve, going into this inversion, we see a massive drop in the markets. But in the short term, there's still a rally that can happen before we potentially correct. See how yield curve, this inversion here, tends to lead into a big drawdown in the markets. So here, the markets went to this inversion. We had a small rally, and then the markets had a big drawdown. Are we seeing the markets further go down to 2024? Quick look at the yearly charts. We are currently tracking well with historical movements, but as we come dangerously close to this aggregate cycle line here, could we see a short-term bounce? Or is this year going to be different? Now, let's look at the market breadth chart. Now, things are starting to look quite interesting we are seeing the equal weight S&P 500 at a critical support level here. Again, only 7 stocks are keeping the markets up. So most of the other stocks have really gone down below their moving averages. We see here the number of stocks below their 20-day moving averages, the number of stocks below their 50-day moving average, and the number of stocks below their 100 moving averages. And they are also dangerously low. Could we finally see rotation happening from the Magnificent 7 to the other 492 stocks in the S&P 500? Right? So we don't usually talk about Bitcoin, but let me show you an interesting chart here in terms of how Bitcoin performs during halving periods. Now remember that 2024 is a halving period. What tends to happen here is that we could see an initial upward move here before crashing back into some sort of a capitulation before it comes roaring back up during the halving year. Could we potentially see Bitcoin rallying back to 6,000 next year? So let's look at this chart here. Let's see how Bitcoin typically performs after a bad year. So we see a bad year here, and then it rallies for 3 years with the halving year at the middle, right? So a bad year and then 1, 2, 3, the halving year being a great year. We had a bad year in 2022. So far, we are up 100%. Could we see a couple more good years for Bitcoin? But of course, don't expect the same numbers to happen for the succeeding years, as government regulation comes in and ETFs get involved. No, we're not going to see growth as high as this. Now, so for this week, we have a shortened trading week with only 2 days in the PSEI. So there's really not much outlook to the markets, but maybe we can talk about short selling, no? What is it, right? What's short selling? So normally, we use our money to buy stocks. We get the stock certificate, and then later on, we can sell the stock certificate for cash, right? So we buy stock certificates and then we sell the stock certificates. But short selling is the opposite, right? So what you do is you're going to sell a stock that you don't have right now. So you have to borrow stocks that you don't have right now so that you can sell it today. Why? Because you're expecting that 1 month after today, that stock price is going to go down. So for example, Ayala Corp at 600 pesos per share, and you're selling 1,000 shares, 600,000. So you are borrowing Ayala Corp shares so that you can sell it now for 600,000, because after 1 month, you are thinking that Ayala Corp shares will become 550. So after 1 month, you spend 550,000 to buy back Ayala Corp shares so that you can return the shares that you borrowed. But you only bought that share for 550,000. You sold it at 600,000. So you earned 50,000 off of it. Right? So that's what it means. Now, 3 things you have to remember about short selling, right? So you're selling borrowed shares. And when you borrow shares, you can borrow them from your broker, from your bank, or from your friend, or from other investors. When you borrow shares, you have to pay interest on that. The current interest that I heard for borrowing shares is around 3.5%, plus other things, other charges, right? So it's not free to short sell. You have to pay a certain amount of money based on the amount of time you want to hold or you want to borrow a stock. Second, you can only short a select number of stocks. Right now, these are the stocks that you can short. You cannot short the whole Philippine Stock Exchange stocks, right? You can only short these stocks. And number 3, there's what we call the uptick rule, meaning you can only short on the uptick, right? What does this mean? For example, a stock opens at 100 pesos. The stock starts going down to 90 pesos. And you might think, oh, this is a good stock to short because it's going down. Now it opened at 100. It's now at 90. I'm going to bet it's going to go down, so I'm going to short it. You can't do that. You can only short on the uptick. So meaning, if you want to short this stock, it opened at 100, it become 90. You can only short it when it goes back up to 101. It's called the uptick rule. So you can only short on the uptick, right? So 3 things: you have to pay interest on the stocks that you short. You can only short select number of stocks, and you have to short on the uptick. So far, that's what we know. Now, if you want to short, you have to talk to your broker about the particulars of being able to do that. You might need to open an account. You have to be collateralized for the shorts also. You have to be collateralized. You have to have a collateral of at least 200% of the amount you want to short. So if you want to short 600,000, you need to have 1.2 million as collateral with your broker, right? So that's another thing, right? So now, if you're not a very seasoned trader, don't short. There's really not much upside to it right now because markets are so cheap, right? So I suggest, it's fun to think about it, but maybe not yet. So for this shortened trading week, don't look at the markets. What I suggest you do as investors, you go out, you visit your stocks. Do you own SM? Do you own AC? Do you own Jollibee? Go to SM. Go to Ayala Malls. Go to a Jollibee store. See how they're doing. And let's talk about it next week. Okay? So that's it for this week. I hope you enjoyed our episode. If you found the information on this episode useful, please like this video. Subscribe to the channel for more updates. And as usual, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week.